Welcome everyone. Welcome to Budget Ki Baat. In this episode, I have with me Mr. Harish Krishnan from Aditya Birla Sun Life Mutual Fund. And once again, we'll discuss one of the most critical things that anyone looks forward to in an year, which is the budget event. And markets are always jittery, volatile, and looking forward to so much. These often come out to be critical moments where the directions come out, new themes come out for investors as well. We'll start from the very top, wherein, sir, Capex is something that everybody looks forward to. What is the Capex going to be this year? It has come out to be 10.18 lakh crores. How happy are you with this number? Do you think this is a good balance for growth of manufacturing industries?
So for FY25, the revised expectations of the budget is at 10.18 lakh crores. Of course, one needs to look at it in the context ki ESR, because it was an election year. You had almost about 3-4 months wherein no spending happened. And so from that perspective, this is a big inch up in the next 1-2 months because we are almost at the close of this fiscal year. And next year, we do see a double-digit increase in capex. The government has done a lot of heavy lifting over the period of the last 4-5 years. So, अगर मैं car का analogy बताऊं, तो if you think about a gearbox, they have already been in the 4th gear for now almost 2-3 years. So from that context, to maintain that velocity and that speed is far more important than to expect that they have levers to further go up beyond that. So I think from that perspective, it has been a good status quo that they continue to believe that they will grow this ahead of revenue expenditure, and this will be in double digits. Of course, they'll always mange more, but in the context of what they have tried to balance the budget, I think this is a reasonably credible number.
Right. How about the fiscal deficit numbers? 4.8% and then 4.4 is the targeted number for next year. Do you think this is prudent enough and it'll balance the inflation concerns and the growth concerns together?
Yeah, so I think this has been really the hallmark of the finance minister, who presented the 8th budget this year, that they've been reasonably conservative with most of their assumptions, thereby bringing in credibility. Also do remember that, while the budget, obviously we all viewed it, investors viewed it, but there is an other stakeholder that views the budget documents very, very carefully, and that's the rating agencies. So if you recall, in May of last year, S&P had put us on a catalyst watch list, which means that they offer an upgrade, which means over the course of the 6 to 24 months, they may potentially view India more favorably than what they have. And therefore, and they had only 2 broad conditions that they were evaluating. One was the state of the fiscal deficit. And therefore, it was very important that they continued this glide path. Of course, the earlier stance was at 4.5%. And therefore, 4.4% is in that sense, maybe kind of overachieving that target. So we would have been okay with even with 4.5, but I think they wanted to be sure. And so I would say that it seems reasonably credible from a perspective of that number, having achieved all these years, whatever they've said. And more importantly, also do remember that, across the world, economies are trying very different tactics. Some are stimulating, some are going for tariff wars, some are depreciating their currencies, etc. In therefore a very unconventional world, India is standing out as a large economy with very conventional policies, which to our mind is going to be rewarded with a better cost of capital dynamics and a greater flow over a period of time.
Right. So getting to the highlight of the budget that everybody's been talking about is the consumption story, the tax breaks that the middle class, the urban middle class has got. How much do you see this impacting our markets, and in what ways will it impact our markets?
Yeah, so I think it'll have a slightly more magnified impact on markets more than the economy. Why do I say that? See, this is not the first time that they've given these tax slabs. If you recall, in 2019, it went from, I think, 2.5 or 3 lakhs to 5 lakh slab. And then in 2023, it went to 7 lakhs. This time, of course, it's moved to 12 lakhs, right? Now the question is, consumption has been suffering all these years. So if that much didn't help, what will suddenly transform in consumption that is going to come through this year? So we are of the view that consumption has its own set of challenges as far as the economy is concerned, especially in the bottom 60% of the population, right? What this focuses on is on a very small cohort of population, which is roughly about 3 crore filers, which will see a benefit of anywhere between 30,000 rupees to as much as a lakh of rupees saved. Which is per filer. So as a household, that number can potentially be even higher, provided that there are two working individuals in a household. So what we are saying is on this focus group of say 2 or 3 crore households, we are talking about a reasonably a high impact kind of a tax cut. Now, why is it important for markets? From a market perspective, if you look at the various consumption stocks, most businesses focus on the top 20-30% of the overall population. It's probably only the FMCG basket and maybe the microfinance or pure agri base that goes lower down the class, right? And therefore, from a market perspective, this 1 lakh crore therefore matters a lot more than what it can do for the overall economy, which possibly will have its own challenges and it will go through its own kind of pace of recovery. But from a market perspective, I think, especially consumption, which has been an ignored sector, especially consumer discretionary, be it consumer durables, ACs, auto, a lot of those sectors, I would say, benefit. Also, do remember that this amount of spending that's going to happen, invariably, most of that is at the higher end of the GST slab at 28%. So if you believe that out of 100,000 crores of tax savings, we would spend at least say 70, at least a quarter of that is likely to go back into the government in the form of increased GST, and of course the multiplier effect of that. So net, I think from a market point of view, I think this is a lot more positive on consumption stocks.
Absolutely. Do you also see some portion of this extra discretionary income flowing into equities or in mutual funds? Our SIPs have, of course, been on the rising trends. People are awakening to the great Indian market story, stock market story.
Yeah, so I think some of the savings, not everything is going to be spent. I think some of that savings will find its way. I think habits are getting formed of using equity as a core saving instrument rather than a speculative instrument, and therefore it is quite possible that some of this money comes into the markets in the form of a greater SIP share. That it's quite possible to believe that connection.
Right. While you briefly touched upon it, if I ask you which sectors would you be most bullish on based on this new unfolding story of the consumption theme for our markets, for investing, which would be the interesting themes to watch out for?
So at the margin, I think, since we are talking of a ticket size of say 30 to 1 lakh rupees, 30,000 to 1 lakh rupees. I mean, it's not really the high-end discretionary purchase of say real estate. To a certain extent, even jewelry classifies in that real high-end. Real high-end cars, possibly not. But say the lower-end cars, the autos, the consumer durables, the ACs, fridges, etc. That segment, right? Credit card spending. I think it would be that set of spends that ideally consumers would want to go, even entertainment, even travel. So if you were taking, say, a 10-day vacation, maybe this extra savings can possibly make it a 12-day package. I'm just saying. So therefore, at the margin, can things move up for, say, travel, aviation, entertainment, media? I think that is the bucket which possibly aligns with this kind of spend package, which can potentially benefit from these tax cuts.
Absolutely. Moving beyond this story, there are a number of schemes that have also been launched. For instance, for tourism, we have the Udan scheme or Heal in India for medical tourism. We have for EV sector, we have got the lithium ion export duties have been reduced. Import duties have been reduced. I'm sorry. Then we have in insurance sector, we have FDI has been the cap has been increased from 74% to 100%. In any of these themes, do you find something in particular interesting which will carry strong headwinds for any of these sectors?
So I think tailwinds for a lot of these sectors are quite good. I think what one needs to marry is, slightly poor last 3 years, last 5 year returns of any of these themes, because then you know that you're not buying into a frothy segment which has already been discovered, right? And where there is earnings potential that can come through. So I would say that, there are pieces. I don't think that, there would be one theme that would fit into everything, but maybe say an insurance segment as a space has kind of underperformed over the course of the last 3 5 years. Every budget there has been something negative which has happened to insurance as a space. This budget, potentially nothing has come so far, so maybe that itself is a reasonable positive. But of course, all the spending that Indians may do for say travel or for buying cars or two-wheelers, ultimately insurance, especially on the general insurance, will see some rub off over that. So it's a bit tangential. There's no direct benefit out of it, but I think if you are able to marry these two things, a significant underperformance going into the event with the potential that there could be an earning surprise, I think that's where I would say that there can be a reasonably sharp move.
Absolutely, absolutely, sir. So moving beyond this current budget itself, any themes that you would like that you see emerging in India for the next, let's say, 5 years or 10 years, the most interesting themes that investors should keep an eye on?
So broadly, among the bigger themes, there are four broad themes, right? You've got financials, you've got consumption, you've got investment, and you've got exports. So if you look from that perspective, financials and consumptions did very well in the last decade, 2010 to 2020, 2019, right? In this decade, they have been on the back foot. Of course, this budget and whatever we are talking about, and the likely change in stance of the monetary policy, these two underperforming sectors can still do slightly better. But the bigger trend is that of greater investments happening in India and India's rise as a competitive export play. And I think, over a slightly more medium term perspective, I would say those would be the areas. Both are manufacturing renaissance that can come through, including in areas, where the rest of the world is vacating. So, for example, in auto ancillaries, we did see a big shift going to hybrids or globally from EVs. If EVs was the only choice, now more and more countries are talking about hybrids. Now, hybrids requires legacy ICE technology and EV. Now, globally, there are very few countries which have the engineering base which still have ICE technologies as a backbone, and India is one of the only countries which is there. So, therefore, what was assumed otherwise to have no end life or terminal value suddenly sees under maybe 5 10 years of prolonged time frame. So I think that could be a very interesting opportunity. Textiles could be a very interesting opportunity. Consumer durables could be another interesting opportunity where we also get into value addition and import substitution in a meaningful way. So I think those would be the opportunities which would be for slightly more longer lasting from a 5 7 year perspective.
Right. So whenever we talk about opportunities, risks are of course the other side of the coin that come along. What are some of the key risks that you see in the next decade for Indian investors?
No, I think from a decade perspective, I would say that of course, the reality is that we are in a very sweet spot because of our median age of population. The fact that we are more working people than dependents. Now, by the next 15 years, our median ages will start moving up quite dramatically. So we've got a 10 15 year kind of a window to really make the most out of, be it in terms of economic activity, be it in terms of GDP per capita, and be in terms of exploiting the various opportunities that various global geopolitics is starting to throw up. So from that perspective, I'm still very, very positive from a 10-year perspective out there, that we've got good demographics, we've got reasonable debt under control, right, and we've got some very strong competent managements. If at all, the only risk is us getting ahead of ourselves with very high valuations to believe that it's a birthright that every year we'll get a 15% return. I think it's our own expectations that are undoing. And of course, in a global thing, in an environment where there is a lot of change and disruption, we need to be watchful that we are agile enough to keep moving into the next technology. I think if we keep these basic things in mind, I don't think we can go terribly wrong investing in a market like India. Of course, the returns might be, say, 1 or 2% lower than what one would have thought from, say, a 10-15 year perspective. But barring that, I genuinely don't think that we can do something terrible by investing in India.
Absolutely, sir. Before we conclude, sir, any parting advice for our viewers out there? It can be related to a key takeaway from this budget or the recent volatility in the market. So maybe something else that they must always remember.
Yeah, so markets. Most investors focus on today's headlines. Okay, what matters for markets is what are the headlines going to be, or what the narrative is going to be, say 6-12 months down the line. Today it seemed, or 6 months back, it seemed that nothing could go wrong for India. Today we seem to be in the camp that everything is going wrong for India. Be it earnings, be it in terms of sentiment, FI selling, we'll find a number of things that when things are bad, it gets amplified. I think we need to look at how this can change, and we genuinely think that over the course of the next 6-9 months, this sense of despondency that we are today in will change for the better. And therefore, if I were to look at, say, headlines, say 6 or 9 months, they'll be very different from where we are today. And it is in that sense that, we need to use this volatile phase to our benefit. Rather than getting worried about everyday moves, we need to take this fall in our stride and say that, this is an opportunity to actually buy into some amazing businesses with a long-term orientation, and to let time do its magic.
Absolutely. Well, this was a time, but this session was an absolute delight. So it was really great talking to you. Thank you so much for your insights, and I hope you'll allow us to learn from you in future.
Likewise. Thank you so much.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.